Hey there, everyone. All right, before we jump in, I asked this survey the last couple of weeks, and now I want to see what your opinion is this week. This will be the last time I ask this survey. Keep doing what I'm doing. You like the videos the way they are? You want singular topics, a little bit shorter focused videos, and more training videos, or even maybe one-on-one mentoring? Let me know. Shoot me some notes in the comments, and this will be the last time I ask that survey. All right, so let's jump in. So what happened this last week? Really not much. We were flying blind. All we had is really some auctions of government debt, some mortgage information, a lot of Fed speaks, but really nothing in the high category, nothing that's going to basically move markets from an economic perspective. In fact, if I just click on what's high, nothing. Take a look at this next week. We do have some higher information. We have the FOMC meeting minutes coming out. We have some data related to home sales and housing starts. So if you're following housing stocks, this will be very important on Wednesday and Thursday. And with the government reopening, we may get initial claims on Thursday. That'll be one to watch. Normally, that's not a big mover, but given that we've been flying blind for about a month and a half or so, that's going to be an important one to watch. We do have other Fed speakers, some more mortgage information that comes out, some energy information. The minutes I talked about, the continuing claims, jobless claims, initial claims, that will potentially affect markets. A lot of Fed speakers. So watch the Fed speakers. They'll give you some indication on what they're thinking for rates. One chart I've been seeing float around this last week is Challenger job cuts. We've been talking about how we've been flying blind. Last week, we got the Challenger job cuts where we had 153,000 layoffs. And I've seen this on Bloomberg, and then once data goes out like this, then everybody talks about it. And this is looking at every October since the early 90s. It is the highest job cuts since October of 2003. So you got to take a chart for what it's worth. These are just Octobers, but I wanted to let's just look at every single month. So let's zoom out on this, and I pull up the same type of data. It's the same exact data. It's just not by October. It's actually by month. And this is the data that they're talking about. This is October's 153,000 job cuts, this little line right here. So I'll draw that. Take a look going back to 2001, 2008, 2009, the financial crisis, COVID. And then you have this January and February timeframe, all this area here in the first quarter. This is all related to Doge. So it does paint a bleak picture. This is pretty high from a layoff perspective. Wait till we see the jobs report. It's ironic that all of these workers here that were laid off in Q1 of this year, they got a 9-month severance package. And so they started in February, March, and April. With that severance package, they were not counted in unemployment. They can't go to the office because they got that severance package. So when they start going to the office for that initial claims, that really won't start happening until October, November timeframe. And that's the report I've been waiting on to see how many of those government workers were able to find jobs. A lot of them were researchers, which are going to be harder for those people to find jobs because of the type of talent and skill that they had. So I wanted to see what it looked like. And it's just ironic that the government shut down right at the time that report came out. And what's interesting is we'll probably never get the October jobs report. We'll get a September jobs report most likely. Don't know when that'll be released. October's never going to be released. November, which we'll get in a couple of weeks, and the first week of December. Problem with that is it's only going to report half the month, and it's going to be really murky if they do report it because it's just they didn't have the data at the first part of the month. So really, you're not going to get a real clean picture until January 1, which then it's got a lot of seasonal stuff in it with December. So really, we're not going to get a good, nice, clear picture until January, February. I don't know. It's just interesting. It's ironic. Maybe a coincidence. I don't know. All right, so let's take a look at the market and see where we're at. First part of the week, we mentioned that it would probably go up last week, and it did for the first part of the week. That is partly because there was the rumor of the government reopening. We talked about that last week. The news started hitting the fan on Friday, and then throughout the week, then the government reopens. And then because of the uncertainty of the data, I don't think the market liked that. Everything started pulling back. They pulled back rate cuts. They pulled back. The market just pulled back in general. From an earnings perspective, 22.75 on the PE ratio. So we had earnings are still going up, 295.95 per share from 295.73 the week before. So this is a positive. We are coming into a seasonal quiet and good time of the year. So we'll see. What really has to hold is this 650, 660 mark, or 6,500 if you're following the SPX, 6,500, 6,600. Somewhere around this range, it has to hold. If it goes below, this is going to be a negative for the market. We're a few points down from 7,000. Will we hit it by the end of the year? I don't know. Wouldn't surprise me. But this is where volatility comes in, and you can play straddles on the market and don't care. I don't care which way it goes because volatility is high. You can play that. You can collect premium and not worry about a directional trade. But overall, the market was flat week over week. The IWM, which is the small cap stocks, which I've been talking about, check this out. Here is IWM, and look at this. Look where it closed on Friday. I actually had 237.50 puts, and it closed out at 237.48. So 2 cents, which means they would have gotten put to me if I would have just let them expire on Friday. It was just like 2 cents away. Like, how perfect is that? But I closed it for a profit, and the reason why I closed it, those puts, is because on Monday, depending on where it opens, I'm probably going to move those puts down. This is called moving them down, pushing them down, moving them forward. And I'm going to move them forward probably a week or two. And I'm going to go out to 230, maybe 230, 250, somewhere along in that range. I will sell more puts there because if the market goes down, that'll still give me some wiggle room. And then I'll collect the premium on that. And if they get put to me at 230, 230, 250, then I'm really buying it on sale. In fact, if I buy it on sale, that'll put me down to about 10% off of its high if I pick it up at, to say, 230, which I'm okay with that. I'll take IWM at 10% off. And with the rate cutting cycle that's coming up, this should be very positive. So I do like that. Fascinating, though. It closed at 237.48, and my puts were 237.50. All right, TLT didn't have a good week. That pulled back. TLT is your government bonds, 20 and 30-year bonds. Closed out around 88-ish, 88, 89. I will be selling puts on TLT because I do think that's the floor. The Fed is going to be buying those T-bills. That's going to put pressure on the front end of the curve. It should also put a little bit of pressure on the back end as well. And so for that reason, I will be selling puts on TLT on Monday morning. I did like that pullback. You remember before, I talked about the ZQZ. Before we go into that, here's the Fed Watch tool, which is made up of the ZQ futures. You're using the futures curve to determine what the Fed cuts are going to be, and they are priced pretty much for each meeting. If you look at December, I'm going to go to the probabilities chart, a 55% chance of no cut in December. They've been pulling that off the table. The Fed speakers, Collins, came out and said that there's a high bar for further rate cuts. So this all is pulling it out. Which I think is fascinating and good for me because I still think it's light. If you go out to ZQZ, that's the one I bought, and I will be buying again because that will put that into this range, this December timeframe. Remember, Jerome Powell is stepping out here. We know we're going to get a Fed that's aligned with Trump. So for that reason, if you have a rational Fed, I'd probably agree with this, but I think you're going to have an irrational Fed coming up. So for that reason, I will be buying this. And look at this, ZQZ. This is where ZQZ is priced. So last week, this is an hour or 30-minute chart actually, and it's basically over the last week or two. I had bought down in here and then sold here. And last week I mentioned I hope it comes back, and sure enough, it did. It closed at 96.89 or 96.90. What that is the inverse. If you take 100 minus 96.90, that's 3.1. That is the equivalent of ZQZ being right here at 3.1. So there's 300 to 325. That's how this is priced. This is just the inverse. It's 100 minus whatever number that is, and that equals R, which is your interest rate. So you're buying it if you expect it to go lower. And I expect it to be in that 250 range, so 2.5, which means 96.1 to roughly 97.50. That would be how you would play this. You can buy this contract for about $2,000, hold it, and each point, $41. That's a very good play. A 1/4 cut being priced back in is 25 basis points. That means roughly an $800 profit on a $2,000 investment. So I'll take that. To me, this is a gift. It coming back to this point is a gift. I will buy it. All right. And then data centers, rough week for data centers. There's a lot of talk about AI. And so this is definitely what's caused the market to come back. Almost a 5% decline on data centers. I'm not buying data centers because there's no liquidity in the puts. So I won't be buying the data centers. AGNC came back to around 1018, 1019. And I'm waiting for that to pull back to around 10. I will sell more puts. And then live cattle futures, I've talked about that. That short, it's still falling. Still makes me upset that I did not hold long enough. All right, so let's just look at some indicators overall. Your put call ratio is still rising. It is on a sell signal until this rolls over. This means that more puts are being bought, so people are a little bit more fearful, which is good because volatility is in, which is a great time to be an option seller. But with the put call ratio rising, that's typically a contrarian indicator. People are buying a lot more puts. Once that rolls over, that means people will be the most scared, and that'll be the time to start buying the market. So at this point, it's not time to buy the market. Looking at new highs and new lows, this is your market breadth indicator. A lot of companies printing new lows. Your VIX printed another buy signal this week where it spiked up to around 23 and then drop back. Anytime it drops back 3 points from its high, that is a buy signal. And then looking at how many stocks are above your 200-day moving average, you have 53% above their 200-day moving average, which is neither a buy or a sell, and 38% is above the 50-day moving average, which means there's declining market breadth. If this gets down to much lower, it's going to start printing a buy signal. It'll be oversold. And then that'll be the time to where you could go long. But at this point, I'm just straddling. I'm selling 20 deltas. And I think straddling to me is the best play because I don't really have to pay attention to which way the market moves. As long as there's volatility, I'm making money because I can sell premium. And I'm just saying this, what I'm doing, I'm not trying to brag. I'm just saying that you can do the same thing if you learn how to sell options. It's probably the best strategy that I know of because you can never, ever predict the market. And here's another indicator that I like to use. This is the McClellan oscillator. In fact, it showed, and this is why I say you can never really predict the market. Look, Wednesday and Thursday, it started printing a buy signal. But yet Wednesday and Thursday, look, it started falling. This is why you can never really predict the market. But this is what happened this week. We talked about buyers rushing in last Friday, rumors of the government reopening, and then talks about the government reopening. Once the government reopened, then it was like, what about the data? What about the data? And it's showing a lot of uncertainty. So I don't know where the market's going to go from here. I think if I were to predict, you might have a couple more down days. You're going to hit the strong support that I've talked about. And if it hits that, bounces, you can expect a rally for the end of the year. Wouldn't surprise me one bit. That's what happens. All right, before I get into this complicated diagram here, we talked about some volatility plays last week where we were going to play Earnings Crush. I only played Earnings Crush on two companies, Cisco and Disney. Cisco ended up being a pretty good play, ended up making about 20% on that one. The stock did not move. But for Disney, on the other hand, the stock moved quite a bit. And what I did is, this is how you'd play the Earnings Crush. And I want to show you this. Let me know if you want another video on I can go really deep dive into this. But basically what you're doing is you're selling a short dated straddle. I sold it for about $8 or $800. And then you buy a longer dated strangle to protect it. And so the way this works is if you look at Disney, it was trading roughly around 116. So what that means is if you were typically selling a straddle without this longer dated, your break even would be 108. So by Friday, if the stock tanks, you're going to pick it up at 108. Even though you're going to get put to you at 116, you collected $8 of premium because you sold both the put and the call. This drops it to 108, and that would be your cost basis. So if the price is right around 105, you're down $300 per contract. But remember, you picked up 800, so that's why you're only down $300 a contract. On a volatility crush play, you're buying this long strangle for $10. So it becomes profitable if you're at 106. So anything beyond 106 is 100% profitable. This is why I'm telling you, I don't care how far the price goes down because I am making money on this side of the trade. This side loses, this becomes a loser, but this becomes a winner. And because I've only got $8 that I collected here and I've got $10 that I paid for here, my true downside is only $200 no matter how far it goes down. When I get down to a certain point, like I am now, where this put on this side is 100% in the money and it's trading at parity, I will close out that put and then I will wrap it with a collar, meaning I will buy a put at 105. Let's say it was trading at 105. And then I'm going to sell a call. I'll put a negative sign here because I'm going to sell this call at maybe 108. This call will help pay for this insurance here, maybe within 50 bucks. All right. So I might have to pay $50 all in for this. So now I'm down 250 bucks because I'm down $200 on this particular trade. I pay $50 for this. So I'm down $250. But guess what? All it has to do is go up to 108. It doesn't even have to go back. Disney does not have to go back to 116. It just has to go back to 108. If it goes back to 108, I'm 100% profitable and I just sit and hold. And that's what I did on Disney this week. So here's the profit diagram. And my profit was up to 122 and down to about that 110 mark or 108, somewhere along in there. When it tanked, it's all the way down here. That long dated put now is 100% profitable. I'll take the profit on that probably Monday morning and I will turn around and then sell a collar. I will sell a collar here. That's for my put. And then come up to here around that 108, 109 mark and sell that there. And that will help pay for the cost of the insurance. So again, if it drops and it continues tanking, this guy is going to be 100% profitable. This guy is going to help pay for that. But if it doesn't, then all I have to do is overcome the $50 extra in insurance. And as long as Disney goes up to this, above this point, I'm 100% profitable. That's why I like this particular play. Now, I'm only going to do this on companies that I believe in. And when I say I believe in, meaning that they are showing a profit, they're making money, and their PE ratio is within a valid point. There's some PE ratios that are crazy high, and I'm not going to do that. Let's take a look at Disney and look at the analyst targets. So here we have the highest guy saying it's worth 160, the lowest one, this guy, the strong sell, saying there's one guy that thinks it's worth $77. It's trading at 105 with the average target with 26 analysts rating them at $133. So there's a good chance that this guy will come back up. And I look at some other metrics and I look at their debt to equity, the 41%. It's a little bit high on the debt, but it's not terrible. I look at their operating margin, 11.7%. They're making money. The most important one on this chart is this one. This is their PE ratio. They are now, from a PE perspective, from a valuation perspective, the cheapest they've been in a long time. So you can see back here in 22, they were like 94 PE. Then they got down to something a little bit more reasonable, like 50. And then something happened here where there's probably an acquisition or something, and they didn't make much money, but their price, so the price to earnings went up a lot, but they're falling. Their PE ratio is down. The lowest it's been, 15.4. I'll take it. I will hold. Doesn't matter what I believe. Disney, it looks like they are making money. They have cash flow coming in. There's momentum behind it. I don't care holding it until I get out. This is the nice thing about derivatives. All right, so with that, these are the volatility plays that I have coming up this week. There's 3,000 or 4,000 stocks that it goes and analyzes, and then it comes back with a much smaller recommendation list, which then I will go out and take a look at. But some of these I will be playing. TJ Maxx for sure. I'm going to play probably Walmart. I'll play Nvidia. I'm going to play that one. So I will play the earnings crush, volatility crush, as I like to call it. This is the S&P 500. This is the Russell 2000. This is what it found in the Russell 2000. So just a handful. Again, these are the candidates. I'm going to go out and look at them one by one. If you guys are interested in this list, let me know, because I could sell this on a weekly basis, a subscription basis, and print this and email it so you guys can take a look. I can do a video on training of what I'm looking at in particular, and then you can trade along with me and learn what I'm looking at. And then this is the NASDAQ. This is the NASDAQ list. I may play Palo Alto. I don't know. I'll go out and take a look this week and report back next week on how I did on these. And these are going to be companies that I want to own. The one I'm interested in, Nvidia. Nvidia definitely has had a pullback, and their volatility is going to be super high, which means premiums on the front month are going to be super rich. And if Nvidia stays within a particular range within that expected move, that's where you can expect to make the profit. All right, last but not least, I mentioned my new indicator I wrote that goes out and looks for certain stocks that move outside a particular range. It's a mean reversion strategy. And look at this DoorDash. It is coming up on a buy. And this one is the one I did lose on. And then I ended up making it back because what I just explained a minute ago about the long straddle and then buying a caller, that's exactly what I did on DoorDash. I actually ended up turning it into a synthetic. And it worked out well. So it is coming up on a buy. I will probably buy some call options on DoorDash additionally. And then the Mosaic is also coming up on a buy. Again, this indicator is for sale. I sell it for $50 a month. You can go in and pick different things. So last week it came up with some recommendations. And you remember it came up with a recommendation for waste management. It came up with a recommendation for Kroger. I did take positions in both of those, and let's see how they worked out. So here's the strong buy that I mentioned this last week, and look at that. Did very well. Ended up getting it at 201, I believe is where I got in, 202, somewhere around that range. And then look, it closed on Friday at 209. Kroger, same thing. I got this one right around 63. And look at that. By the end of the week, it was 66.71 is what it closed out on Friday. So the target range on Kroger is somewhere around 68. So that said, this indicator is for sale. If you have TradingView, you can easily add it to your TradingView indicator. You can go out and screen, and then if you have your own favorite companies, it'll let you know when it's time to buy and when time to sell. And again, it's just a recommendation. It is not financial advice. So you got to take it for what it's worth. Do your own research. And with that, I hope you enjoyed this video. Happy trading. Good luck. I'll see you guys next week.